Thailand is weighing whether existing crypto firms should be allowed to offer derivatives, and that could redraw the local market faster than it sounds. The pressure point is simple. Thailand may let licensed crypto firms add derivatives without creating new entities. Thailand SEC May is the search phrase, but the useful issue is who gains, who loses, and which rule or right changes in practice. That is why the practical rule change matters more than the political slogan around it. The Thailand SEC is reviewing possible rule changes that would let licensed crypto exchanges and brokers offer derivative products through their current legal structures, instead of forcing them to build separate entities. The detail that matters most is who gets access under the rule change and who keeps the power to say no. This puts a real procedural marker on the story instead of leaving it at rhetoric. The review is still early, which means the regulator has not disclosed the exact licensing path, the eligible products, capital thresholds, or whether the scope would include futures, options, or perpetuals. In plain English, regulation shapes access, product range, and legal confidence long before it shows up in a token chart. Once the formal structure appears, the winners and losers become easier to identify. For people typing Thailand SEC May, the practical issue is enforcement, access, or voting power, not the headline alone. If approved, the change could keep more Thai traders on regulated domestic platforms rather than pushing them toward offshore derivatives venues with weaker protections. That is the step that turns a debate into operational consequences. The mechanism is licensing efficiency. If already regulated firms can add derivatives inside their existing structures, the market can expand faster because the operational barrier to launch falls. For people searching, KW, the useful question is not whether policy sounds positive or negative. It is who can operate, what they can offer, and under what constraints. The legal mechanism matters because markets adapt to rules long before they adapt to narratives. That matters because derivatives usually dominate crypto trading volume. A local framework could deepen domestic liquidity, create new revenue for licensed firms, and pull leverage activity into a setting where the regulator can at least define the rules. A small drafting change can shift an entire market if it widens or narrows the legal path for exchanges, issuers, brokers, or investors. This is where affected users, platforms, or investors start calculating real compliance or access costs. What remains unclear is how tough the investor protections will be. Margin rules, leverage caps, suitability checks, and product scope will decide whether the change looks like a careful opening or a risky speed-up. The next signal is an official consultation or draft text from the Thailand SEC. Until that arrives, the story is not that derivatives are approved. It is that the regulator is testing whether to widen the gate. The open question is not cosmetic. It decides how much room the market actually has. That leaves Thailand SEC May hanging on the next formal step, because speeches and posts matter less than enforceable rules or court filings. This stays a rules story until the next legal step lands, because access, compliance, and market structure change long before price action catches up. The next official move matters more than another round of commentary.